Okay. Okay, so hello to you all. Today I'm going to share with you the second update that I have with the product of Hercules Volatility, and I'm going to show you the improvements that I've been making into it. At the same time, some new additions into it. And on top of that, like if you are not used with this product, I'm also going to explain you how to make use, of volatility in general with or without my product. But anyway, in this case, the most session part of this stream is going to be related with the new update from the Hercules Volatility. Anyway, with this in mind, so let's get on with it. I have included in this case, the interface is going to be similar with the first version. However, I have improved the calculations from the inside, and now, for example, we are going to have the normal logic like we had before. Because in this case, normal logic, it means that we don't care about the percentile where we are currently, on the volatility, and between percentile here we can calculate concrete moments, from the past where, like for example, we would be right now between on 98.8, so we can go here between 90 and 100. And we can see the data. For example, in this case, we can see that the average accuracy is going to be 27%, so it means we are 73% of the time right. However, if we are going to go to the normal, we can see that we are going to have 90% probability or 10% to be wrong. So in this case, we can see that once the probability is higher, our strategy is not working entirely as intended. Which means that it's much more profitable to be buying longs and calls than to be selling the puts and calls. In this case, for the Iron Condor, which is the main strategy that we are using with the Hercules Volatility. On top of that, at the same time, now I have improved the calculation, for the out and in. So we can see that now, for example, if we are going to go between the percentile, we can also see the data, being correctly updated for this part. But yeah, in this case, for example, if I go with 50, we can see that it's going to change. In this case, it's going to take a look at the entire scenario, of course. But yeah, let's go back to the normal logic and let's make the calculations one more time. With this in mind, the new additions that have been made, the proper calculation now from the distance from the top and the bot, the proper calculation for the in and out win streaks. So this part from the out, you can consider it as a losing streak. So for example, in this case, the maximum that we can have, it would be 3 losses in a row. The same, for example, with this case, it would be 3 losses in a row. The part from the top, this one, it means that, I'm taking into consideration that the current volatility is lower than the previous one. So we can see, for example, in this case, the current volatility, 2.07% is lower than the previous one. So the purple area is going to be related to, with this part from here. If, for example, this current value, the current value is the second value, it would be higher than, for example, we would go with this part from here. This is very good, in general, when you have very, very high volatility, then like more than normal. So it's going to help you, to properly analyze if it's the good situation right now to sell or buy. At the same time, I have created another place, because in this case, the C, it means that I'm looking at the close of the candle. So in this case, for example, I am analyzing, from 268 candles, it's telling me that 28 of these candles, the close of the candle, it crossed either top or below the level. So for example, in this case, we had this place to say like this. This C is telling me that the close of the candle was either here or here. But then I have created this one, so this we can use it as a reversal or as a continuation, depends, on the way you want it. And, in this case, it's telling me, like, for example, imagine this. So let's say, for example, we have a daily candle, right? And we have 6 hours of trading. So within 6 hours of trading, it's telling me that actually 52 times our high, like for example, you can see this scenario here. So imagine, for example, this scenario from here. So you can see that the high actually crossed our line, and in this case, it's going to be represented here. But at the end of the day, we can actually see that the close was victorious. So in this case, it's telling me that, for example, if I would have 52 candles, and I will have, for example, in this case, 52 crosses with the high or with the bot, I am actually going to lose only 28% of those. So in this case, 24 of them, are going to be fakes. So what does it mean? Like for example, in this case, you can expect when the price is going to be at this high. So imagine, for example, in this case, it would be around here. So if the current price is going to be near the same place, your strategy delta in this case is going to be 0.5, because you will be at the money, because price is going to be around here at this moment. Like I said, this is expected more or less to be taken within the day. You know, like when the trade is already happening, we have the initial values, we didn't enter the trade, but suddenly we see that now the current price is the high just crossed this part. So in this case, we can expect that, you know, most of the times the price is actually going to go below. So we can see in this case we have kind of close to 50%, because you will have to rest this from this. So 50% of the time we are going to have a reversal from that high. It means that it's going to go down, or from the low. Like for example, the same, we would have from the low and it's going to go back. However, we can see that, for example, if we would go back when we will have this here, which it was more a bearish here, you can see that in this case, you know, when we had from the top, more or less it was kind of the same. But for example, in this case, when we had from the bottom, we can see that we had a lot of crosses in the bottom initially, but then we had a reversal. So we had actually, if you will take it like this, let's say you would have, we will have 10 entries, 6 out of these entries would have been reversals. Only 4 times, you know, the close of the candle actually closed above, you know, that point. So this is how it's supposed to be used. It's in general, so these parts are going to be together. Like I said, this part is going to consider when the volatility, the daily volatility for today, it's smaller than the previous ones from the yesterday, for example. While in this case, this part is doing the same, but in this case, we consider that the current volatility is higher than yesterday. So let's take, for example, a replay. Like if I would go, for example, here, you can see in this case, for example, now I have 2.8. No, this one. Like, for example, this is a scenario from this part. You can see that in this case, my current volatility is 1.91%, and yesterday it was 1.87. So in this case, you know, this scenario applies for this part. And in general, this is very nice to know, because, for example, if we would go from 2020 and we will go with a normal logic, we can see that in this case, actually, most of the times, like 71 out of 115 candles, the current volatility was higher than yesterday. And at the same time, if you are going to take a look, we can see that when the current volatility is increasing, like for example, yesterday it was 1.87% and today it's 1.91. So when it's increasing, actually, our rate actually it's you know, we are going to have more mistakes as well. So in this case, we only have a 70% win rate. While in this case, when the volatility was decreasing, like for example, which is the place, like for example, of today, we can see that in this case, our probability was 87%. So if I will have to trade this one, like for example, in this current situation of the market for 2022, we can see that when the volatility is decreasing, is giving us a much bigger advantage than when the volatility is increasing. So what does it tell me? Volatility is decreasing, very nice, for example, to do a short sale, like, no, sorry, we are going to do a normal iron condor. But when the volatility is increasing, it's much better, you know, to go for a short iron condor. So like, for example, because we are expecting, you know, big volatility moves. So with this in mind, at the same time, like imagine we have in this place, but then on top of that, I'm going to say, okay, but what happened between 90 and 100%, like if it's our current scenario from here. And in this case, it's going to take a little bit to calculate. But in this case, for example, if I will go like this, you can see that with this very, very high scenario, you can see that actually 29% of the times, you know, we would be wrong with this tool. But yeah, of course, we don't have enough data. We might have to use a little bit more sample. But we can see that, for example, in this case, for 90 and 100, if you would sell between 90 and 100, you would have a very, very, you would be in a danger place, to say like this. But for example, if I would sell instead when the volatility is around, let's say, for example, 50 to 75, you can see that in this case, it's going to be much more safer. Look the difference. So in the general, our average right now is going to be 92.5, while for example, if I would use, like I said before, with 90, with 100, you can see that in this case it's 72. So it's a very huge decrease for us. So I know most of the people in general, when you are reading courses on internet on finances and everything, they are telling you, oh, you got to sell when there is a high volatility because you are going to get a lot of option credit from that. Yes, but at the same time you can see that your chances are going to be fucked up as well, because when there is a high volatility you can expect the movements most of the times to also go higher than your initial levels. So yeah, these are going to be, you know, the new additions that we have from that. And then, for example, maybe I didn't explain this one, but I'm going to explain now better. So for example, this distance on the top, on this dust on the bottom, is telling me that on those moments, on these 27% times moments, when the price crossed above, you know, our initial top and bottom level, it crossed 0.1% on average. So like, for example, if we have this level here and we cross it, in this case, for example, actually the price is going to be somewhere around here. And in this case, for example, as well, it's going to be somewhere around here. This one in general, it can help a lot by, you know, when you are trying to define, you know, the spreads entirely. At the same time, if you want, if you are going to use, for example, a smaller coefficient, and in this case, for example, we are going to look for explosions. In this case, for example, imagine we are going to have, let's say, this is going to be our range, nah? Because we are expecting the price to be either above this or above this. So in this case, for example, it's telling me that from this point it moved 1.2%. You know, and from this point it moved, for example, 1.4%. In general, when we are going to have these explosions, like for example 86% of the time. At the same time, for those that wants to do a straddle, like we can see that on average from 110 candles, 95 out of them, in this case, for example, 86%, the price went either above or below. But there was also, in this calculation, because I am not taking the close, I'm not taking a look at the close of the candle, but in this case I'm looking at the high or the low of the candle, we can see that within the same candle sometimes it can happen both at the same time. That's why the ratio here, for example, is bigger than 1. Because within the same candle, like for example you had this place here, you can see like pam and pam, it broke at the same time. But yeah, the close in the end, of course, it only went towards one place. So this one as well can be very great if you are going to do, for example, some straddles and you are looking for the explosive movements of the volatility. This part can help as well. So yeah, these are the biggest new additions that I have added into it. So I believe, you know, they are the current version is much more powerful than it was before and much more accurate. And now you can expect and calculate more precisely, you know, the data. With this in mind, the general resolution that I have, for example, for this, you know, for this year, is that if I will take a look one more time, in this case, for example, when you have a bearish here, like for example this one, you can expect that, once again, I repeat, when the volatility is increasing, your chances are going to be lower to be able to profit from an iron condor, and instead you are going to profit much more from a big volatility movement like a short iron condor or, you know, or a straddle. And at the same time, if the volatility is decreasing, you are going to be able to profit from an iron condor. And we can see, if I'm going to take a look, for example, in 2008, we can see that in 2008 it's happened more or less the same stuff. You can see that overall, you know, overall we have an 80% probability here to be right, but if I'll take a look in 2020, well, it's kind of similar. But yeah, it looks like this year, you know, it's a little bit more different than all the others. So overall, until at least for now, you are going to benefit, like I said, one more time, more from the decreasing movements in the volatility than from the increasing. So yeah, like for example, if I will take a look at the entire data since 2000, sorry, and yeah, we can see that overall, overall the data is there. But if I will take a look, for example, at the normal logic, we will have an 84%. But in this case, if I will take a look, for example, from 0 to 50 percentile, we can see that our ratio is going to be actually close to 90%. And if I will look, for example, from 50 to 100, you can see that it's going to be 78%. So we are going to benefit from from doing a long iron condor much more when we have a smaller percentage than a bigger one. And then again, when we have a bigger percentage, like for example, if I will take a look at the explosions, like for example this one with 0.5. So let's go, for example, in the normal logic. You can see that on average with this part, we are going to be 45% of the times the explosion is going to happen for us. However, if I'm going to take a look, for example, from 0 to 50, you can see that it's going to happen actually only, so if I'm going to take a look at the percentage, you can see from 0 to 5, it's going to happen only 38% of the time. But if I go from 50 to 100, you can see that I'm going to have actually a 50% probability that is going to happen. So I repeat, you will have a bigger percentage, like for example this one, you can see we are going to be 56. If I'll go to 90, maybe even going to be 60. Yeah, so it's a 60% probability that the market is going to move above or below the prices that we established. But when we are going to have, for example, from 0 to 10, we are going to have a very low probability that the market is moved. So in those situations, it's much better to profit from an iron condor. So yeah, I would say these are the biggest lessons that we have right now, and these are the newest additions, you know, for the product. And if you have any questions, feel free and let me know. Thank you all for watching, and see you next time. Bye bye.